Welcome to this year's UNEP Global Roundtable. This session will discuss how regulatory and financial authorities are working to deliver a sustainable financial system. My name is Elodie. I'm the Global Policy Lead at UNEP, and I will be the moderator for this panel discussion. What we're going to discuss today is in part driven by the growing interest and commitment from the global private finance industry. We have seen over the last years the success of market-based and voluntary initiatives, such as the Principles for Responsible Banking, the Net Zero Finance Alliances, that are showing that private finance wants a transition in the real economy. But it's also driven by the planetary crisis in terms of pollution, greenhouse gases emissions, and biodiversity loss that will affect the stability of the living environment, and of course of the financial system, which requires policy interventions. Over the last years, both developed and developing countries have seen a growing increase in sustainable finance policy and regulatory measures. The finance industry increasingly needs harmonized and sound policies that ensure clarity of direction to help prevent reputational risk and also fight greenwashing. There are three main topics for discussion today with our panelists. The first, we're going to discuss collaboration and harmonization for transparency and disclosures. Second, we're going to discuss climate goals and transition plans and where the collaboration should happen as well. And third, we're going to discuss biodiversity loss and nature and how those issues get to be progressively integrated into the regulatory frameworks. Without further ado, I'm introducing to you the regulators with us on the panel today. We have Ravi Menon, who's the Managing Director of the Monetary Authority of Singapore. Ravi also chairs the Network for Greening the Financial System, the NGFS. We have Martin Spolc, who's the head of the Sustainable Finance Unit at the European Commission, DG FISMA. And we have Petra Hielkema, the Chairperson of the European Insurance and Occupational Pensions Authority in the EU, EIOPA. In terms of opening statements, Ravi, Martin, and Petra, as a start, could you please each take 2 minutes to explain your point of view on the need for greater alignment to deliver a sustainable financial system on the international level? If I may start with Ravi and then Martin and Petra, please.
Yes, thanks Elodie for that introduction, and hi to Martin and to Petra. Good to see you. I'll keep this brief. An important point I'd like to make is that while it's very encouraging that a very large number of global financial institutions have made commitments to achieve net zero by 2050, I think it has sent a very powerful signal. And it has, I think, given impetus to sustainable financing. The next step, very critical next step, and absolutely important, is that they start the process of setting very clear targets for 2030. Because this is the critical decade. According to the IPCC, we need to peak carbon emissions by 2025 and reduce emissions by 2030 by 40 to 45% relative to 2019. Currently, we're not on that track. Emissions are still rising, and emissions are only projected to come down 7.5%. So we are way behind the emissions trajectory. And financial institutions in particular, and we'll talk, I think, later on about transition plans, and I think this is central. It is not about a net zero commitment in 2050. It is about a transition plan. How are you going to get there from where you are, and what is your intermediate position in 2030? These targets need to be science-based and aligned to the Paris Agreement temperature goal of limiting global warming to 1.5 degrees Celsius. So this is very critical that we have these sectoral pathways set in place in this decade, and actions being taken in this time. And I think I'll also touch on later on about transition. So it is not just about de-risking, it is about achieving a meaningful transition that is effective and inclusive. I'll stop here. Thank you.
Thank you, Ravi. And Martin, please.
Thank you very much, Elodie, for having me today. We have entered a very special moment here in the Sustainable Finance Agenda. We have been working on this agenda, as you know, since 2017, and we have done a lot in Europe to put in place a number of tools. We have enforced transparency, and obviously now it's the responsibility of the financial sector and the businesses to start using these tools. And of course, we are here to support them on their efforts. Now, what I would like to say is that the focus on making the whole framework work and the usability and coherence aspects, not only in the domestic level, but at the international level, is one of our key priorities. We have obviously heard a lot from the financial sector and the businesses that they have obviously cross-border activities, and however good the framework is in the EU, they are facing specific challenges when they are having business elsewhere. So as we expect now the financial sector and the businesses to start using the tools and really do the work, to introduce the change, we as policymakers now have to focus on making sure that the framework works. And one particular aspect of this usability is international convergence of the different frameworks. We are aware that there are many jurisdictions that are now developing their frameworks. And we are aware that this kind of fragmentation is indeed causing a lot of trouble. So we do need, as policymakers and regulators, we need to step up now our efforts at the international level, and we are already doing it, and I'm happy to explain it later how.
Thank you, Martin. Petra?
Yes, thank you, Elodie, and thank you for having me. It's an honor and a pleasure to be on a panel with Ravi and Martin. And what I'll add to what has already been said is yes, there's a lot of urgency. There's a lot of policy in place, a lot of policy on how to assess the risks in your organization, on how to report on that. So what I would say is necessary is we need to do it. Companies need to start doing it. They need to start being transparent. They need to think that if they say green, it really is green. If you lack the data, don't say it's green. This is the risk of greenwashing I'm referring to. Assess the risks you have. No longer discuss whether or not it's really a risk. It is a risk. I think we're beyond the point of asking whether it's a risk. And because it's a risk, there's a crucial role for the financial industry to deal with it, and also to help society deal with it, particularly for insurance. The second I want to say is do it together. We cannot do this each on our own, be it regulators or policymakers or industry or financial industry. So in Europe, the SFDR had the sustainable finance disclosure requirements coming into being. We clearly see we miss the CSDR, so the reporting from the rest of the industry. We need that too. So I think it's a joint exercise. So we need to do it together. And in the same way as Martin already, Ravi alluded to, we need to do it at a global level. We need to recognize that business is also cross-border, cross-jurisdictions worldwide. So we need to do it together. And the final thing is we need to do it now. We need to really start doing it. I know it's difficult also for supervisors, also for industry. We don't have everything but we would have liked to have at the start, but that means we need to be pragmatic going forward. Concretely, question often asked, Petra, how will supervisors deal with the fact that SFDR is already in being and CSDR is not? And I say pragmatic, but keep moving. We need to start. So we need to do it. We need to do it together, and we need to do it now.
Thank you very much, Petra, Martin, and Ravi. And then indeed, my first question then for you is about transparency and disclosures. Martin, we've seen and we know that the EU has prepared and is delivering on quite an extensive disclosure framework across the entire financial system and sectors. What do you see as the biggest barriers in terms of those disclosures taking place at the global level and different frameworks that are being developed? Where do you see the collaboration needed?
Yeah, thank you, Elodie. I mean, as you rightly said, we have imposed new transparency requirements not only on the financial sector, but obviously also on the corporates, because in order for these transparency requirements to work, the financial sector needs also data from the corporates. And we have introduced several pieces of transparency or disclosure requirements. The first one that is already in application is the disclosure on taxonomy alignments by the corporates and taxonomy alignment of the financial sector of their exposures. And this is already real, this is already in application. The next transparency will come at the level of the financial sector. We have just heard from Petra on the SFDR that will come next year. And as you know, we have now successfully concluded negotiations in Europe, in the European Union, on the corporate transparency, the CSRD. And we believe that these three pieces, of course, also supplemented by additional disclosures by the banks, will bring the necessary minimum integrity into the market and will bring clarity not only about the impact that the climate change and environmental degradation causes and has on the financial sector and businesses, but also, and that's very important, the impact that the financial sector and the businesses have on climate and environment. You have seen that this principle of double materiality, is really in the heart of the EU sustainable finance agenda, and we believe that this principle should be pursued also at the international level. So if you ask me what should be the priority now for the EU, of course we are working with the different international standard setters, and we are trying to make sure that our standards are as close as possible to the latest developments at the international level. We cannot compromise on the fact that this transparency has to be based on the double materiality principle.
Thank you. And Ravi, if I can also have your views on this notion of double materiality across disclosure frameworks. And also, we see that around the globe, central banks have started to stress test on climate, their financial sectors. And we also see that central banks lack quality data, they lack good data to make those assessments. So what is your view in terms of transparency and need for disclosures globally?
Thanks, Elodie. Martin has put it well, the case for disclosure and transparency. Let me take up from there. Why is it so critical for central banks and supervisors? Now, there are three things that central banks and supervisors are doing to advance credible and inclusive sustainable financing and transition plans. And at the NGFS, we call it about greening the financial system. One is climate and environmental risk management being embedded in supervisory processes. And this is something that the NGFS has been actively advocating and more jurisdictions are doing. Needless to say, effective climate and environmental risk management needs data. Second way in which we're doing this is scenarios and stress testing. The NGFS has published now most recently the third vintage of its climate scenarios, which are widely used by many stakeholders. And this has a way of focusing the mind on what are the possible physical and transition risks that financial institutions will be subject to and what kind of contingency plans and adjustments they need to make. So stress testing, scenario analysis are critical components of the supervisory process, which also requires extensive data and disclosure. And last, data and disclosure itself, we need to put in place the fundamental foundational architecture. What do I mean by this? There are many data systems and data sources across the world with respect to climate and environmental risks, with respect to the carbon footprint of different activities across the supply chain. We need a way to harness these data systems and make them interoperable. Second, there are emerging disclosure standards. We've heard about the EU initiative, which is ahead of most other jurisdictions with the IFRAG standards. We've also seen the recent publication of the draft ISSB standards, the International Sustainability Standards Board, under the IOSCO framework. Now, we need to ensure comparability of disclosure standards. Let's be realistic, there is not going to be a single disclosure standard across the world, but we need a global baseline and we need a mechanism for ensuring interoperability of these disclosure standards so that there is comparability. Otherwise, you're going to have a fragmentation. And I'm very heartened that both the IFRAG and ISSB are in close consultation to try to bridge and maybe not harmonize or make it uniform because they serve different purposes and there are different priorities. But the ultimate objective is the same. We want to use this to promote climate action and so to make them interoperable. On data, I think this has received not much attention internationally, but in the financial industry, if you ask them, this is the number one problem. Even before disclosure, upstream, you need high quality data. And this is something we need to work on very much. There is a lot of climate data residing in a myriad of data aggregators, data registries, and there are solution providers across the world of different standards and qualities. And countries have started to develop their own national data platforms. The European Single Access Point is a good example. And in MAS in Singapore, we are doing what we call Project Greenprint. And maybe I'll just finish off by describing how we are trying to address this in Singapore. So we worked with industry partners to develop 4 interoperable data platforms. Now, this is a digital architecture which is designed to be interoperable with other data platforms. And it has 4 things in it: an ESG disclosure platform, a data orchestrator, which aggregates data, an ESG registry, and an ESG marketplace. So this will collect and aggregate ESG data across multiple sectoral platforms and industry players and make it available for use by the financial sector. And a quick word on the disclosure portal. With the mandatory disclosure requirements now becoming more common in more jurisdictions, many companies are going to struggle to meet these standards. And so what this portal does is to allow listed companies in Singapore to upload corporate sustainability data in a structured and efficient manner and automatically mapping them across selected frameworks and standards. Then this information is accessible by external stakeholders, provided they get consent. It will considerably streamline and reduce corporates' ESG reporting burden, which many have fed back is becoming a major challenge. And we don't want this to stand in the way of meaningful disclosures. So I fully endorse what Martin has just said. Transparency, data, and disclosure are absolutely critical. And we need to build the infrastructure to make it happen. And finally, we need to make it interoperable and use technology to make it scalable. Thanks.
Thank you, Ravi. And Petra, I just heard streamlining the data access and then lowering the burden on companies. I also heard Martin talk about usability of those disclosure frameworks. So my question to you is twofold. One is how supervisors can help indeed support companies and support the financial institutions with this burden, increasing burden. And second, if you could shed light on the insurance industry, specifically in the EU, and how you see this from the insurance.
Yes, I can. Thank you. And I think many good things were said, and I very much concur with the summary that Ravi just gave about data and comparability and interoperability. Now, you say very well, Elodie, it's an extra burden on supervisors, by the way, and on industry. It is. At the same time, I do think it's core business, because it's about risks, and it really is about risks that need to be addressed. So it is what you should do. It's just that these risks are more specifically identified recently and need to be dealt with. One way, of course, is to be very conscious of what we ask and don't do double reporting. A second is to carefully listen, now that we really start, to what are the difficulties and can we deal with those? Can we make it easier? I was very happy to say, Martin, that going forward also legislators stand ready if there are things that need to be improved, because it won't be perfect from the start, but we need to listen. And I think secondly, we also need to recognize that this is not something extra, as I said at the start, but it really has to happen. And I think the way to really identify that is stress testing, and providing help with the stress testing, also indicating where already more advanced, for example, modeling, scenario modeling is taking place. I think in the modeling community, there's already a lot happening when it comes to climate modeling and climate scenarios. So let's not try to invent the wheel, but really, again, do it together and learn from that part of our economy and see how we can work that. A second part is, and I think here as supervisors we can really contribute, is to provide data where possible, open source through dashboards. And here at EIOPA for Europe, we're building a NetCat dashboard currently. We're in a pilot phase, but we hope to be able to start publishing end of the year, beginning of next year, where we identify where physical risks are and why they are there. So I think that is also a way to deal with it. And finally, I think keep the engine on. So even though it will be hard at some points, be pragmatic, but keep moving. And I've said that before. Now, specifically, if I look at the insurance industry, it follows the same logic that we heard. So first of all, it's embedding it in your risk management. That has to happen in insurance in Europe, in Solvency II, in the ORSA, the own risk solvency assessment. Now, what we do here is we have published application guidance. And what the word means is that if it is helpful for you, please use it. If you feel you can do a better job because you already started, because there's different speed in industries, please keep going. But we put it out there to help those who still need to move or need to move more, to get ideas on how to deal with it and how to work with it. The second thing that is out there, of course, is the NGFS with several scenarios also for stress testing that we also very much like to use. The second part is stress testing. We've done this in the past, but because the term stress test was so sensitive, we called it sensitivity analysis, but we've done one on transitional risk, we've done one on physical risk. And I think sharing these outcomes really, again, help to show that there is an urgency to start going. Now, finally, with Solvency II, our legal framework being reviewed, we're very happy that there is a mandate proposed by the Commission, still on negotiation, but the Commission is proposing to review the net cat risk module. I think that's key. You get more data, more insight. And the second is to indeed look into risk differentials in Pillar 1 for insurers. And I think that, again, will be a good step. A final thing that we're doing, and I think then we're getting slowly to the transition part, is that I think we really as supervisors need to signal not only to industry, but also to society that green finance is about becoming green and not by being green today. It is a transition. And here, what we need to be very alert on is that what we see in practice is that once industry looks at the risks in insurance, it could also choose to just exclude in those risks and no longer insure those risks. And with that, we will create a growing protection gap. Now, this is counterintuitive to the business of insurance, the managers of society's risks, but how are they going to keep insuring risks while at the same time recognizing that some of these risks might even be risks we cannot transition, even with a transition make green. So I think this is a discussion we need to have going forward. And again, here I'm very happy that the Commission, DG Climate and DG FISMA together are starting now a roundtable on, particularly for net cat risk, how to deal with insurability and protection gaps. And I'll stop there.
Excellent, and thank you for making the transition for me, Petra. This is great. So just turning to you, Ravi, as we move into indeed talking about climate goals and transition plans, you already alluded to this as being a major priority. We are indeed seeing that numerous attempts at defining transition plans for financial, but also for non-financial institutions globally. It's happening at the multilateral level. It's also happening in countries, in the EU, obviously, in the UK, in Japan, in Singapore, indeed. So how are central banks and supervisors collaborating, including through the NGFS, to help bring about credible and inclusive transition plans, as you mentioned earlier?
Thanks, Elodie. Yes, I think this has now emerged as one of the most important issues on the sustainable finance agenda, which is all about effective and inclusive transition plans. To get to net zero, every economic sector will need to decarbonize. Every major business must have a transition plan. And it is not just about, financing solar farms and wind farms and clean technologies. It is about financing today's manufacturing, building and construction, agriculture, maritime, aviation, all of which emit a lot of carbon, and to get them to transition over time. So it is not about creating a green economy. It is about gradually greening the existing economy. And if you look at the numbers, only about 8%, the green economy only makes up about 8% of global GDP. The rest of the economy is not green, and we need to start gradually doing that. And this brings me to my second point, which is the role that financial institutions play. They should support an orderly transition, and they should be very mindful of indiscriminate de-risking from firms in hard-to-abate sectors. You take steel, you take cement production. These are very hard-to-abate sectors where the technology is still prohibitively expensive or hard to obtain. But we can't leave them be because they are still parts of the economy. And so financial institutions need to support the orderly transition of these firms. Not to finance them is not the way to go forward, but to finance them in a blind manner is also not the way, because I think we're only adding to the carbon footprint. So we need transition pathways and transition strategies. financial institutions must get better at providing transition finance. And so if you take, for example, shifting agricultural practices or phasing out coal production, I think simply withdrawing from these activities doesn't make sense. We need to be in these activities and to have a phase-out plan, phasing out of high emissions activities over time, and set ambitious targets which need to be Paris aligned. Otherwise, we will not get to net zero. So I think we can use finance as a powerful catalyst to do that. And there are many such efforts. GFANZ, the Glasgow Financial Alliance for Net Zero, has published a note on expectations for real economy transition plans, as well as a report on facilitating a managed phase out of high emitting assets. This is where you can move the needle. You need a managed phase out of high emitting assets so that you can bring about drastic reductions in carbon emissions over the next 5, 10, 15 years and get them from non-green to green. Financial institutions also must obtain good climate and sustainability related data on their customers and their investee companies' business operations. So I think these are some of the things that we need to do. The NGFS is looking into, in its latest work plan, into the area of how supervisors can engage financial institutions on their transition plans. What is a good, credible transition plan? Does a transition plan take account of alternative scenarios? What are the assumptions you're using about technologies? So there's a whole range of things that we need to buckle down to. And supervisors, I think, can play a critical role when they interact with financial institutions on these transition plans and get them to be better and better over time. Petra made an important point. We're not going to get it right the first time. It would not be perfect. I don't think we don't want the perfect to be the enemy of the good. So let's start with good, reasonably good transition plans, continually upgrade and adjust them, disclose them so that there is market commentary and market discipline. And over time, we get better and better at this. Thank you.
Thank you, Ravi. Thank you very much. Martin, would you agree to describe to us the framework in the EU around those transition plans and the transitioning framework?
Yeah, thank you very much, Elodie. I mean, I think that Petra and Ravi explained very eloquently why we are talking about transition finance, so I don't need to go into that. I fully agree with what they said. But let me then be specific what Europe has done. As you know, last year, the Commission adopted a new strategy on sustainable finance, and financing the transition towards sustainability was the first key pillar, and it still remains the case. So I'm very happy that the debate now is moving from why we need to talk about transition, not only talk, but also action on transition, to how we do that. So let me say a few words how we are doing it in Europe. Apart from this narrative and that we have explained in our strategy, we have already put in place specific requirements for companies to develop transition plans, which again, we believe would not be only a regulatory burden, which is obviously, you know, a necessary part of the framework, but in the first place, a useful tool. We want this agenda to be useful, and we would like that businesses and the financial sector perceive this agenda as an enabling agenda, not only as a regulatory burden. And why this transition plan is important? Because this could be a very important tool to explain their transition targets, strategy, milestones, and investments. So I mentioned the CSRD, the Corporate Sustainability Reporting Directive that was recently agreed in the European Union, and there is a requirement now for companies that are covered by this regulation to disclose the transition targets, strategy, milestones, and investments, of course, based on the European Union reporting standards. This is being complemented by the proposal on the Corporate Sustainability Due Diligence Directive, with an obligation for boards to adopt climate targets and transition plans as a director's duty. So there is another piece that is coming in Europe, which will be not only a transparency obligation, but a behavioral requirement. And finally, I mean, you know, of course, I mentioned taxonomy. We do believe that taxonomy disclosures can feed into the transition plans by helping set sub-targets for economic activities and capital expenditures to meet these sub-targets as part of an investment plan. We have also adopted climate benchmarks regulations where there is a lot of emphasis on transition pathways. So we have done a lot at the European level. And what we are doing now, we are working together with the stakeholders, also through our platform on sustainable finance, to give a sense of everything what we have done across these pieces in a holistic way. So we are working with stakeholders and with the markets to explain how our framework is effective in supporting transition. Now, finally, and sorry for being long, we are not working on these areas only at the EU. I mentioned earlier that we are very active at the international level. A specific example is that Europe is not only a member, European Union is not only a member of the G20 Working Group on Sustainable Finance, but we have established a dedicated group of countries, the so-called International Platform on Sustainable Finance. And this group is being asked by G20 to work on transition finance specifically. So we are leading, together with all our IPSF partners, a dedicated report that would identify key principles that should underpin a robust transition finance framework. So you can certainly look forward to more details shortly. Europe certainly wants to continue the lead on this area together with all the international partners of the IPSF. Thank you.
Thank you very much, Martin. This was very comprehensive. And the last point we wanted to discuss in today's session is about biodiversity loss and the loss of nature. And we've seen, Ravi, a report published by the NGFS a few weeks back around the integration of those risks into the scenarios for stress testing. So if you could elaborate a little bit on how the central banks are slowly looking into those risks as financial system risks. And then I also go to Martin and Petra for the EU framework. Thank you.
You're on mute, Ravi.
Yes, we can't hear you. Thank you.
Yes. Okay. All right.
Yes, good. Thanks.
Yes. Along with climate change, this is the other central challenge facing mankind, which has got to do with the depletion of nature capital. The loss of biodiversity sounds like a rather technical phrase. Basically, what it translates into is the degradation of soil. It manifests itself in reduced water supply, air pollution, and threats to food supply. I think when you put it in those concrete terms, air, water, and food are basic to human survival. And in many parts of the world, the loss of biodiversity and the degradation of nature capital is affecting these three things. So one of the efforts that we need to make is when we talk about environmental risks, we need to translate this into concrete bad outcomes that financial institutions then should be mindful of in their lending or their investment decisions and work to address some of this. The second challenge is this. Unlike climate, where you have a single metric that you can measure, which is basically greenhouse gas emissions, a molecule of greenhouse gas emission in Europe is the same impact on the climate as a molecule emitted in Singapore. They're treated the same, and they ought to be. But with climate, with environment is very different. The soil conditions are different. The water systems are different. The air currents are different. What you do in different countries have different effects. So effects of biodiversity loss are very location specific and more difficult to measure and compare across. So these are real issues. But that doesn't mean, but if you leave them unaddressed, their consequences can be devastating. So we are working closely with the financial institutions to develop better metrics to measure these things. And instead of trying to boil the ocean, to focus on a few concrete bad outcomes arising from the loss of biodiversity, and then to see what their effects are. Now, the effects have financial implications. And this is one of the things that the NGFS work has acknowledged and found that nature-related risks are relevant for central banks and supervisors because they're potential macroeconomic, macroprudential, and microprudential materiality. And the extent and severity of these risks are more difficult to assess but the absence of perfect data should not prevent central banks and supervisors from taking the necessary actions. And there are also complex interactions between different environmental challenges, say between biodiversity laws and climate change. And so we need to study them together and understand the implications together. Very often, climate change and damage to the climate has a bad effect on biodiversity and food supply and so on. So the strategies are aligned. But there are also situations where what you do to mitigate climate change can have adverse effects on biodiversity. So if you're building a solar farm or a wind farm, for instance, the location matters, because if you build it in a place that's going to affect biodiversity and degrade nature capital, that would have adverse consequences for food supply and food supply or air pollution in those geographic regions. So you need to be mindful of how these decisions are taken together, that the environment cannot be divorced from the climate decisions, and we need to take them together. So to further this work, the NGFS has established a task force on biodiversity loss and nature-related risks. And basically, it wants to incubate, explore, and harmonize the relevant nature-related considerations and efforts, this being much more complex than the climate issues. And we're bringing together expert networks to help us get a better understanding of this. Basically, I would say for nature-related risks, you need to make the problems more tractable, more tangible, more actionable in quantities that financial institutions can focus on and address. Thank you.
Thank you very much, Ravi. Martin, how is the European Commission looking at biodiversity and environmental objectives in its framework, please?
Elodie, I will be specific and I will use 3 examples. The first one is obviously a taxonomy, which is, as you know, in the heart of our sustainable finance framework. So far, we have developed the climate taxonomy, activities that substantially contribute to climate change mitigation and climate change adaptation. But now we are working very, very hard on developing activities and criteria for the other 4 environmental objectives. And biodiversity is one of these 4. So as you know, we have a dedicated group, the Platform on Sustainable Finance. They have already developed a number of criteria, some recommendations for us in March, and they are going to finalize their report in 2 weeks' time. There will be another report that they will submit to us. After that, we in the European Commission will work on those recommendations, and the objective is to obviously adopt another delegated act that will set out these criteria for these other 4 environmental objectives, including biodiversity, which will facilitate considerably investments with a huge positive impact on biodiversity. Now, when we talk about biodiversity, we should not be only talking about the positive impact and how businesses and financial sector can bring a positive change, but we should obviously also talk about the risks. And that's also why the CSRD, the reporting disclosures, the reporting directive in Europe that is now concluded will bring more clarity, and especially the new KPIs that will be set by EFRAG. As you know, the framework is a general one, but then we will need to define what exactly needs to be reported. And there will be specific examples of KPIs that will focus on biodiversity. And again, not only on the impact, but also on how the businesses and the financial sector are facing those risks stemming from biodiversity loss. And finally, I should mention that we have been really impressed by the work of some supervisors, either national, and also I would like to congratulate Ravi. That he's focusing the work on the NGFS on biodiversity, and obviously also our agencies in Europe. There is a much more attention now on biodiversity in their work. We are very encouraged. There have been several reports on biodiversity, and what we are doing in the Commission, we are compiling all the work that has been done. We have mentioned biodiversity as one of the key element of our next steps on sustainable finance. So we are compiling and consolidating existing work and existing methodologies and studies on measuring risks stemming from biodiversity loss and ecosystem degradation, drawing on this work of Banque de France, of the Dutch National Bank, NGFS, etc., and so that we can ultimately be much more specific what it means. We do need to go into the nitty-gritty, as we have done for climate, also on biodiversity if you want to make an impact. Thank you.
Thank you very much, Martin. And Petra, how is this topic being looked at from the supervisory angle in the EU at this point?
Yes, thank you. And I think the way to look at it is very much, again, and I think this is also where the mandate comes from for supervisors, it is a risk. And if the risk manifests itself, it will have an impact on the company. And so you need to deal with the risk. Now that is, you need to manage the risk yourself, but you could also through stewardship reduce the risk. And this is where double materiality comes in. I think there's a logic to taking that role in stewardship, being an investor, and mind you, as an insurer, also being an insurer of risk and trying to reduce the risk through mitigation and adaptation. And I think that in itself is very important. So what is very helpful, I mean, my previous life, I was with the Dutch Central Bank, and what the Dutch Central Bank did was really took the logic of analyzing climate change risk and then use that to work further on biodiversity. And I think that is a great step to assess the risk. So I think the first step to actually assess that there is a risk and see the impact on the financial industry is something that we can do already, and we see an impact, and with that we see an urgency. What I agree with Ravi is that then when you want to deal with that and what is the solution, it becomes more difficult in the sense that it is so much more based on location, on where you are, not even in the world, but even within a jurisdiction. So and also what kind of risk we are dealing with. So I think when the solutions and the need for adaptation mitigation, it becomes much more diverse, and that means also people, financial industry, on location that probably better understand how you can deal with it. But again, I very much see a role there. Having said that, I think the tools are in place, the notion is starting, but we really need to do more to make it as much as climate is part of our thinking. For in the end, whether the risk was caused by what was caused by climate change or by biodiversity, in the end, it's something we need to deal with. And that maybe brings me to a final point, more insurance specific, that I want to make. And again, any player in the financial industry has their side of the balance sheet where they need to be conscious of their assets. But when it comes to insurers, they also need to be conscious of the liabilities in the sense of what have they underwritten, and is the risk still what they thought it was, particularly in a time of a cost of living crisis and inflation going up, and therefore damages going up. And again, here is the question of insurability. So I think the time where we maybe thought that just by making sure we are insured well, and then we still can deal with the risk because we're covered, I think that time has passed, because the costs go up way too much with the climate events on the rise, and biodiversity still only becoming visible, but very much there. Because whether your crop is no longer good for sale, whether that was climate or biodiversity, the damage is the same. Now, how to deal with those damages and how to deal with the rising cost of those damages, and how to prevent protection gaps for the economy, I think this is an important question. And the role that supervisors can play here, it is really a question that we as supervisors, and me and my board, we really asked ourselves, do we have a role here? And we concluded we do. If you look at it very narrow as a prudential supervisor, you could say no. I mean, if they exclude it, there's no risk, we're all safe prudentially. But that's of course not the route we took. We really see the purpose of insurers to be managers of society's risk, and in order to be that, they need to be able to offer products, they need to be offer products that are affordable, but that also address the risk that society wants to address. We also recognize that sometimes might be difficult, but as an supervisor, we understand the risk, we understand the models, we understand the data, and also the challenges of the data currently, and we have no commercial interest. And I think it is here that we can really contribute to the discussion of protection gap, and affordability, and bring that further, because I do think we need to do that, while recognizing that whether it's climate or it's biodiversity, if it is a risk, we will need to deal with it.
Mm-hmm. Thank you very much, Petra, Ravi, and Martin. We're actually coming to the end of this conversation. Thank you for all this great input. I think as a very brief conclusion, we've seen over the last years, especially 5-6 years, an increase in financial regulatory measures that have come to financial institutions, but also to the corporate world. So the question now, when it comes to what is the role of supervisors, regulators, central banks, authorities, is not so much whether there should be a role, but rather what is the role and how should regulators be supporting the finance industry, but also be active drivers of the transition. We've talked about biodiversity, the loss, and nature, having in mind this notion of double materiality, where it's not so much and only a risk of financial stability and a prudential issue, but it's also a risk on the living environment. And what is a risk on the living environment? As Ravi mentioned, it's about air and water and food. Is it about human survival? And so as we think all together in terms of how to assess those risks from a prudential and supervisory and regulatory measure, we see that also there's a discussion moving towards how to enable the transition, how to enable the restoration, and how to enable the protection of that environment with supervisory and regulatory means. So thank you so much for this conversation again. And thank you to everyone who's been listening to this session. Welcome to the UNEP Global Roundtable again. Have a nice day. Bye.
Thank you, Elodie.